Let's bring in our first headliner of the day, Chris Hyzy. He's the chief investment strategist joining us today from Bank of America. Chris, welcome back.
Thanks, Scott. Appreciate that.
Yeah, so you heard, people putting money to work on this show today. Others maybe having a little more cautious approach to where we are. What say you?
Well, I like the word measured. When there's craziness and there's high volatility and there's the great unknown and uncertainties at the highest level, you're going to see a lot of people come out and not only be bearish, but actually suggest they know the end game to all of this. And we see a lot of this, in the industry. I think the most important thing is again, we're going to go back to discipline, diversification. And this group here on this particular program has a garden of opportunities. We've already heard some of them. And that's going to continue, in our opinion, below the indices. Now, at the index level, Scott, it's important to keep your eyes wide open to at least see the bell shake. Now, we may not hear the bell ring when there's a bottom, but at least see it shake. And you look at all of your different indicators. You start with valuation. We got overextended. Everybody knows the story there. We're down 10%. The median level in the S&P's PE is now back to where we were in 2019 or below that. The free cash flow level is way above that relative to 2019. And, when you look at the sectors that are leading, they all have tailwinds to them, and they're not cresting yet. And last but not least, the starting point in all of this as it relates to the consumer, the corporation, household balance sheets is so very different this cycle versus prior cycles when everyone's trying to gauge is a recession coming, which we don't believe. So we have to be disciplined. We're going to look to rebalance as well. We're going to do it measured. We're going to be patient about it. And there's a lot of opportunities below the index.
You think we bottomed on February 24th? Did we put in a short-term bottom as some are, not only speculating about, but letting their dollars do their talking?
If you pick the right time frame, it's one of the bottoms. Now, we've heard already people talk about in the last few weeks and today saying that there's more to go. And you know what? That's okay if there's more to go. As long as we start to see order restored, stability, you're going to have multiple bottoms. There's no the bottom, right? We all know that. So we think going back to those levels would just provide a further reason why sentiment should start to turn and go back the other way and the wall of worry be climbed again. And again, no one knows the bottom. It's one of them. And we're looking to rebalance in the coming few weeks as we get to the summer and the full reopening of the U.S. economy, which was just talked about, really starts to get going again.
I feel like you're suggesting that earnings can hold up in the face of all that we've seen already and what the Fed is going to do. And you may be, on an island of that view, or certainly approaching it, because I keep hearing about the trend or negative earnings revisions, and earnings are only going to go one way from here, and it ain't up.
It's kind of a balance beam, right? You're going to hear a lot of companies come out and try to take advantage of the terrible situation that's going out there in terms of the clouds and start to forecast down. We're already seeing some of that. But if you roll it up, the economic profits, nominal GDP still being way above average, some pricing power in specific industries, not just energy, but even materials and some industrials. And the consumer with all their excess savings is still opening up the pocket, at least most of the cohorts, and still spending on it. Plus, we haven't even seen the pent-up demand filter fully into travel, leisure, and entertainment. So we don't want to be overly cyclical. And finally, established technology is now down to levels, price to sales, the big growers, below what we've seen over the average of the last 20 years. So no, we don't know the actual bottom, but I can say this. Consensus earnings estimates are now coming down to 5-6% over last year, with nominal GDP 8-9% or greater. If we avert a recession like we believe, then consensus earnings estimates are too low still, even though we're seeing those negative revisions. We think they're quite higher.